Well, good afternoon. 4:15 here in Cincinnati. We are going to do chapter 16 using effective promotions, as you can see, and then we'll move into chapters 17 and 18, which talk about first financial accounting and then managerial finance. Now, let's look at our objectives for chapter 16. Identify the new and traditional tools that make up the promotion mix. Contrast the advantages and disadvantages of various advertising media, including the internet and social media. Illustrate the steps in business to business and business to consumer selling processes. Describe the role of public relations department and show how publicity fits into that role. Assess the effectiveness of various forms of sales promotion, including sampling. And finally, show how word of mouth, viral marketing, blogging, podcasting, email marketing, and mobile marketing work. If you look at this particular slide, then you can see this at figure 4.1 in your text on page 448. We have such things as personal selling, sales promotion, public relations, and advertising. Now, first thing I want you to take away with this is that personal selling is very intense. We're talking about taking someone or someone's out and having them make some type of a presentation to a potential customer or customers. Now, of course, this can be done by virtual medium that we're using now or something else. But when you do that, some of the personal touch is lost. Some of the personal touch is lost in what you and I are transpiring with here this evening and have through this course, because we can't reach out and actually touch each other if we wanted to do that. I'm not saying that we should, but we have that opportunity. And you may have the opportunity to see my facial expressions and things of that nature. I can't see yours for the most part. So it's difficult to know how well we're interacting. And that's why personal selling tends to be face-to-face. Notice what this talks about: integrated communication, integrated marketing communication, and providing the tools that we talked about into a comprehensive strategy. One of the things that companies want to do, we've talked about this before, is to create a brand image. Have people buy into the brand so it creates brand loyalty. Whatever we're doing, remember, and we've talked about this, and many of you said this in your reflection papers and in your posts in the forum section, and that is to create a positive relationship with consumers that meets their needs. Now, notice what we say here: needs, not wants. And the reason I say that, and the reason this says that, at least at my estimation, is that we are focusing on providing what the customer actually needs: housing, clothing, automobiles, things of that nature, some type of transportation. Maybe not just an automobile, but other types of transportation. People might want entertainment. They might want DVDs and smartphones and things of that nature, but they don't need them. Now, I know you're going to tell me in today's world everybody has to have a smartphone, and that's probably true, but you can get along without one. And then, obviously, to meet what the company wants to do, its initiatives, its objectives, its goals. Now, this gives us the promotional campaign. And there are a lot of things on this particular slide that we can talk about. But with the two top things are identifying target market target market, excuse me, I didn't enunciate properly, and then defining the objectives that the company has. And we go all the way down through this. And then the last thing we have to do is we have to evaluate the plan or the campaign, if you prefer, that we set in motion to make sure it did what we expected it to do. And if it doesn't, then everything else in here really is irrelevant or has become irrelevant, and it's not going to get us anywhere. And then I suspect the other thing is that we really want to focus on in a promotional campaign is identifying this as a unifying message. I would prefer to say identify a message that connects with the customer. Because if it doesn't connect with the customer, it might unify us within, but it doesn't make any difference. Now, this is something we have to look at here that really a lot of us may not think about. Look at what this says, that advertising is paid, non-commercial, non-personal communication, not personal, personal, non-personal communication. We do this through various methods, and what transpires here is while it is non-personal, the advertiser or the advertising campaign is trying to personalize the message, to get that message through to you so that you understand it and so it resonates with you. So while it is non-personal, because nobody is standing there in front of you, it tries to create a personal message, at least in my estimation. And of course, in advertising, we're trying to tell our story. We're trying to get you to buy something or to remind you, hey, we're still in business and we want your business. This just talks about amount of advertising that's spent on a yearly basis, $215 billion in various forms. And there's various types of advertising: retail, trade, business to business, institutional, product, etc. And to measure things we try to do some advocacy, some comparisons, interactive online, mobile, etc. And we're all familiar, I think, with each type that we list here. I don't know how well you can see this slide, but you can see it graphically displayed at the top of page 450, figure 16.4, talking about the millions of dollars are spent in various types of media advertising. Now, this talks about direct mail campaign. One of the things about direct mail, I think the major thing about direct mail is to understand that a return rate on direct mail is not very high. And if you get 14 to 20% return on direct mail, it's probably going to be very effective. One thing to mention here, and it goes down here at the bottom, and this is what we're talking about here, direct mail. One mailing usually is not sufficient. You have to get back to people and tell them over and over what you're trying to do. Now, I'm not going to talk about that. That's just one of those things that I don't pay a lot of attention to. TV advertising, or using TV as a medium through which to advertise, is still the dominant. And of course, we know that there are some things going on through that. Excuse me for the interruption. Notice here about online experience, what this says, and I would challenge each of you to think in your own minds whether you find this is right. Brand messaging is key. If you buy online, do you do that? I don't want to try to answer this for you because you may have a different experience than I've had. But what you want to be able to do is make sure that the website, if you're going to do this, or their online experiences, is people can easily navigate it. That's probably the best tool that you can have. If it's not easy to navigate, you're probably going to lose customers. Here's how a number of companies, notice Dr. Pepper and Richard Branson, who is the founder of Virgin Atlantic and Virgin Airlines and a few other companies with the name Virgin in them, what they do to maintain communication and make sure that their advertising is working. Social scammers, I really am not going to be too concerned with this. I think we all should pay attention. Social scammers are around, and they do everything, including sending you messages that the IRS has filed a lien against you, and they're going to come and take you to jail if you don't pay up. And unfortunately, people fall for this on an everyday basis. The big thing here is don't give information out, period. And of course, if somebody actually asks you for that, just your best bet is to hang up on them. I'm not going to get into global advertising, but I do want to talk about personal selling. And as I mentioned before, we could say that something like this medium that I'm using here this evening is a type of personal communication, but really it's not. And it can't be considered personal selling, although it is used to try to help move product from place to place. Personal selling is face-to-face, very intensive. It's also costly. So far as we have come in this world, nothing has replaced personal selling. Now, that doesn't mean to say it won't be replaced, but it isn't. I want you to think of this, and we've talked about some of this in the past, but think of this as a two-way communication here. It is the salesperson making a pitch, if you will, to use that term. But he or she also should be listening to the customer and trying to make sure that whatever he or she is selling is going to meet the customer's needs and exceed his or her expectations. Transactions should be made easy. I didn't say simple. I said easy, because you're going to have to introduce the product. You're going to have to answer objections. You're going to have to show how this product is best for his or her uses. But it shouldn't be convoluted. These are steps in the selling process, and they are pretty much the same regardless of whether or not you are using the B2B approach, business to consumer approach, or the business to business approach. And here they are. And I'm not going to go through these, or they're listed in your text. And you can see them. We've talked about these in the past to some extent. But the big thing that you have to be able to do more than anything else is to make sure that the person you're talking to, the person you're trying to convince to make a purchase, is qualified to do so. That is, he or she has the wherewithal to say, yes, I can buy that. That is regardless of whether we're doing B2B or B2C selling. Close the sale talks about a trial sale. You say, how would you like this, or when would you like this delivered, or how can I set this up for you, or something of that nature. You're moving that person along. So you're making a positive statement. When can I deliver this? Would you like it delivered next week? Maybe that's even more positive. So you're helping to move the person along to make the sale, to make a buying decision on his part or her part. Obviously, you have to follow up, go back and find out whether things are working or not. This is just going back through the steps that we talked about. Again, the first one, making sure that person has the wherewithal to make the buying decision. If he or she does not, you've got to go back and find somebody who does, because you're wasting your time. Here are some things here to just talk about the success and promotions, etc. Know who your competition is. Understand, know who, sell to the people who are most likely to buy. Obviously, that's build relationships, and then make sure you get the right people there. I'm not going to talk about that. Now, you notice here that the B2B, business to business, or excuse me, the B2C, business to consumer, is a little bit different. So you have an approach, you don't have a pre-approach, a little bit different here. Asking questions, making the presentation, closing the sale, and again, a follow-up. And you can see this graphically displayed at the top of page 459. Public relations is kind of what it says here, but one of the things that we do, it's, you're trying to move the public along here. The idea here is to find out what the public thinks and then try to change policies. You try to change mindsets in a way. Turn whatever you're doing into action. These are the 3 steps in a good PR program. Listen. If you don't listen, you're not going to know. And by the way, when you listen, you don't talk. And that might sound like a smart aleck statement, but it's not. In many of the courses I've taught, we talk about effective listening. And one of the first things is a cardinal rule is to stop talking. You can't listen and talk at the same time. It's just impossible. And then the last step, and I've always liked this, is to stop talking. Make sure that you understand what's being said. And that's part of promotion. It's all, again, you're trying to change policies and procedures, and then you're letting people know that you've heard them and you're going to take action. Now, look at what publicity is. We don't think about this all the time. We think about publicity in some other terms. It's information that's given out about something, someone, or some place. It's not paid. So if I want to do a publicity campaign and I send it out to local radio stations and TV stations, and maybe even see if I can get something in the local newspaper, I'm not going to pay for it. Notice the first word says down here, it's free. You're hoping to get it to people who ordinarily wouldn't hear about it. And because of the way it is, it appears to be more believable than advertising, because it's done as like a public input or something, a public information. There is, however, a distinct disadvantage to this. I send this out, and I'm going to call it a press release, publicity press release. And I send this out to local media, radio, TV, newspapers. I have no control over when it's going to be aired on radio, seen on television, or placed in a newspaper. And depending upon how it's placed, it can come out with a good light or a bad light. I send it once. If I get the story run, article, whatever I want to call it, run once, I can't expect it to be run again. So whatever it is I say the first time, whatever message I want delivered the first time, it better be right because I'm not going to get another chance. Sales promotions come in two categories, business to business and business to consumer. And these are just different sales promotion techniques. So we've all seen these. You can see this graphically displayed at the top of page 462 in your text. Business to business trade shows and catalogs and conventions, and then to the consumer, things like coupons and sampling and premiums and things of that nature. And there's some, again, just a little bit better graphically displayed than what I have shown before is the coupons, demonstrations, etc. This is the best type of promotion or advertising that you can get, and that's word of mouth. And it is really good for the businesses that it mentions here. These are businesses that depend upon foot traffic, depend upon people coming in and making a purchase of whatever it happens to be. And it's very important that you get those types of people, and having good word of mouth really improves the ability of these organizations, businesses to survive. Viral marketing is an emerging tool. I'm not going to spend a lot of time on this particular piece here. One reason I'm not is I just don't know how successful it is. I know that we're bombarded with it. I know that people get this on a routine basis. Obviously, you can set up your smartphones and everything else to get certain messages. I just don't know how successful it is. And so I'm not going to talk a lot about it. If you have some feedback for me, I'd be glad I'd be happy for you to send it to me, and we can share that with the rest of your classmates. Blogs and podcasting and email promotions, all important. There are two types of promotional strategies. One is a push strategy. That's just to get things out there. Notice what it is: personal selling, sales promotion, etc. And this is to get the product where it needs to be in front of customers so they can make a purchase. The pull strategy, on the other hand, is heavy on advertising and promotions, directing customers toward customers, and gets the public to request the products. Now, let me give you an example of that. The best example of it is, for many years, the only way that you could get a prescription drug or influence your physician to give you a prescription drug was to go to the physician, have an ailment, and have him or her prescribe something, and then you get back to that person, to the provider, and say, well, it worked or it didn't work. Today, we have a lot of commercials on TV for cholesterol drugs, cholesterol-lowering drugs, or drugs to treat diabetes, and a few other things. And almost always the tagline says something about ask your physician. So what this is giving you the information to go to your physician and say, when you have some kind of issue, and it doesn't have to be as serious as high cholesterol or diabetes, hey, doc, what about giving me XYZ drug I heard advertised on TV or read about in the newspaper or magazine or something else? So here it says requesting it from retailers, but in this case, you're requesting it from a provider. And that's the best example that I can give you. I mean, there are commercials on about lowering cholesterol on a routine basis. Same way with some drugs for diabetes. Same way with drugs for allergies and things of that nature. We just didn't have that years ago. Well, this is a short chapter. We've spent 25 minutes here. I'm going to take a short break. It's now 4:40, and we'll come back at 4:43, just turned 4:41, and begin discussing Chapter 17, Financial Accounting. Please come back at 4:43. Thank you. All right, 4:43, we're back. Chapter 17, Understanding Accounting and Financial Information. And our objectives for this course, I've lost my ability to shorten this to somewhat to get this all on the screen at one time, and I can give it to you. Demonstrate the role that accounting and financial information play for a business and its stakeholders. Identify the different disciplines within the accounting profession. List the steps in the accounting cycle, distinguishing between accounting and bookkeeping, and explain how companies are used, and how computers, are used in accounting, and explain how the major financial statements differ, and then demonstrate the application of ratio analysis in reporting financial information. The question that's posed here is, what is accounting? And accounting is simply, as it says here, classifying, summarizing, and interpreting. You might want to use the term analyzing the financial events. Let's use the term transactions. It says here events and transactions, but let's just stick with transactions. Events kind of confuses that a little bit. Of your organization, and then provide that information to interested parties. Now, financial accounting and financial information is given to outside interests. Yes, it's used inside the company, but it is mainly for people outside the company so they understand the financial conditions, the financial health of the organization of which they're interested in. As a stockholder, as someone who is not an investor, someone who's a supplier, to someone who's a consumer, the government, anybody else who's interested in that company. And this mentions all the people here down at the bottom that I just mentioned. The accounting system, this particular slide can be seen in your text, figure 17.1 at the top of page 175. And if we look at this, this is similar to what we have talked about before. Inputs, processing of raw material, this would be, in this case, would be raw data. And then our output is going to be our financial statements. So we're taking what we have here, sales documents, purchasing documents, etc. We're putting them through a process normally would be considered journal entries or bookkeeping entries. And then we're going to tally those. And then we're going to produce a report or reports. And the major ones are listed here on the right-hand side, and we'll talk about them in a little greater detail in a few minutes. Balance sheet, income statement, statement of cash flow, and then there's some other reports. But those are the three major ones that we're going to talk about. These are our accountant's responsibilities, and we're not going to spend too much time on that. Matter of fact, we're not going to spend any time on it. And this is our managerial accounting. We're going to analyze this stuff, and we're going to give this information to the various supervisors if they are involved with it, managers, and certainly top management of the company, to help them make decisions. It's involved with costs. It tells us about the cost of our production, how much it costs to market, and preparation of budgets and controls. And then finally, telling us about our tax information, tax liabilities, and information of that nature. Now, uses of accounting information, we've kind of gone over this in some fashion, pardon me, if you will. Now we can, pardon me, we can see this at the bottom of page, again, 475, figure 17.2, that tells us what particular entity uses a report, and then what they're going to do for us. So, we have tax returns, we have other required reports. Required reports for, it says government regulatory agencies, required reports. For the most part, that is speaking about companies that are publicly traded. If a company is publicly traded on one of the stock markets, which we'll talk about next week, then they have to file quarterly reports. If a company is solely owned or wholly owned or privately owned, better way for me to say that, then what's going to be transported to the government way of reports will be the annual tax return, not a quarterly statement. And then the managers, they have to have these financial reports, as we mentioned before, so they help them make the decisions that they need to make. Now, financial accounting, and I want to tell you, a lot of people really get confused and concerned about accounting. But accounting at its simplest definition is simply addition, subtraction, multiplication, and division. There is no mumbo jumbo in financial accounting. Now, having said that, can somebody flow with the books? Yeah, absolutely. But assuming, I know sometimes that's a big leap, that people are doing things that they're supposed to do and they're being ethical, accounting is really simple and straightforward. And you can manipulate things, you can make things say what they want to say, what you want them to say as opposed to what they ought to say and things of that nature. I understand that. But that's not the purpose. And it's not, people get really overly concerned about accounting and they don't understand it. Now, I'll be the first to admit to you that accountants use some facts and use some figures and do some compilations that makes it a little difficult to understand. But if you're dealing with numbers, and that's what people are dealing with, they're dealing with, cash in and cash out. Let's put it on that way. It's like your checkbook. There should not be any confusion into what's being done. You should be able to look at figures and tell immediately whether your company is in sound financial shape or it's gasping its last breath. So here are the questions that financial accounting wants to answer. Am I making money? Can I pay what I owe? And how much debt do I have? Now, that's a problem that a lot of people have when they get into the debt business. You and I know or understand that when we manage our checkbook, if we have more going out than we have coming in, we're going to be in serious trouble. Companies, large companies, do a little bit differently, and they pile up debt. And one of the reasons they pile up debt, which we're going to talk about when we get into bonds and stocks next week, but particularly in the bonds, is that you can have a debt, and some of that debt is tax deductible. So a lot of times for a company, not an individual, a company, it makes sense to borrow money and have this debt because it's tax deductible. And so you'll find that some companies in the United States have large amounts of money stored outside the United States. Won't bring it back because I think our taxes are onerous. And yet they have debt because it's a lot easier for them to finance new purchases for upgrade of equipment, for new machinery, etc., through debt, mostly by bonds, issuing bonds and having people buy the bonds, and of course, which have to be paid back, than it is to bring that money back. Now, I'm not going to get into that. I probably shouldn't have introduced it too much as it is, but it gets you to understand that it's a little bit different between what an individual can do as an individual, not a business owner, and what someone else does who owns a business. Now, these are the things we talked about these before. These are the big things that you have to be concerned about, and the report. Management discusses, and by the way, you'll get an auditor to do the same thing for you. Analysis of the operations. In other words, you're good shape, bad shape, or not. And there's the balance sheet. There's the income statement, and a statement of cash flows. And those are the biggest three things we have to be concerned about. We have a number of different types of accountants, public versus private. Private accountant works for a single firm. Usually a public accountant usually has, obviously, or should have more than one customer. Can be both individuals and businesses. Certified public accountant is an individual who has, in most states that I know about, has a bachelor's degree plus X number of hours over and above that before he or she is eligible to sit for the National Certified Public Accountants exam. I've never taken that exam. I understand it is very onerous, and many people do not pass it the first time around. Only people who have passed this can say that they are a certified public accountant. Now, this just talks about ways to improve accounting practices. And notice here, we talk review, change current procedures. That means your procedures ought to be looked at and reviewed on a fairly frequent basis. Pardon me. Hire an independent firm for consulting. Now, I want to tell you, Here's the problem with that. If you hire an independent consulting firm, the only way you're going to get a unvarnished report is to give the consulting firm free and unfettered access to everything. That usually does not happen. A CEO, and by the way, I'm not saying this in a negative sense, a CEO will say he or she wants something investigated or audited, and have a consulting firm come in and look at something, but it's maybe not the entire picture. Pardon me. So you have to be careful about what type of consulting is being done. Now, an audit is usually a little bit different because that's across the board. But again, you know, somebody can say, well, this is what I want audited. I don't want everything audited. You really have to be careful about what's being done, what's being asked for, and making sure that everything is open and above board. We have the Dodd-Frank Act. I'm not going to spend a lot of time on this, but the purpose of the Dodd-Frank Act was to increase financial regulation oversight. Notice here, by increasing the power of the Public Company Accounting Oversight Board. Some of that would be done in other things with the Securities and Exchange Commission and things of that nature. We got to the Dodd-Frank because of the disastrous recession that we started in late 2007 and morphed exponentially in 2008. Many companies, especially financial institutions, have been working tooth and nail to either weaken Dodd-Frank or overturn it completely. There's a yin and yang in this country between, well, we don't need any regulation and let us do whatever we're going to do because we're nice people. Well, we know that most people are nice, but not everybody's nice. All we have to do is think about the Bernie Madoffs and the folks that ran Enron. Those people in the world to know that we do need some type of regulation. So the yin and yang is we don't need any regulation to sometimes we have too many regulations. And we've never been able to seem to find a happy medium, because once we seem to find a happy medium, then somebody gets mad and says, oh, there's too many regulations. And we go through this all the time. So do we need the regulation? Yes, I think we do. Personal opinion, obviously. The regulations need to tie people's hands? No, but they need to make people be accountable. And that's what we're talking about. You should never worry about being accountable. If you're doing business in the daylight, nothing's going to happen. But if you do business at night, nobody can see you, or pull the shades down when you're doing the business, and somebody needs to figure that out. Auditing, by the way, is not just related to facts and figures. You can audit any type of their business operation. But here we're talking about looking at financial statements. We talked about independent auditor, certified internal auditors, someone like a CPA, except that they're auditors, they're not public accountants, and there is a bachelor's degree, et cetera, and these people do have to take a national test to become certified. Well, I don't want to have to, I think, talk too much about that first bullet up there. Fraud is just bad, and it really impacts the company. It impacts their image. It impacts a lot of things. We have the SEC committed to fighting fraud, and yet we find the SEC is hamstrung because it doesn't have enough investigators, and Congress probably doesn't give it as much money as it should. And then, of course, they say, well, you know, if the regulators pull in business, then we become anti-competitive, et cetera. So we get back to this yin and yang type thing. We have specialized accountants, those people who are tax accountants, and that's exactly what they do. They prepare tax returns. And then we have government and not-for-profit accounting organizations that obviously are not in business to earn a profit. All right, now we have the accounting cycle. And this particular slide, also depicted in your text as figure 17.4, which you can see at the top of page 480. Now, if you will notice, it is a relatively simple procedure. So we're going to get our documents, we're going to analyze them, and we're going to record the documents in the journal. We're going to then transfer those again to a journal entries, from the journal entries to a ledger. Take a trial balance, in other words, see where we stand, prepare the financial statements, and then analyze them. Now, the steps 4, 5, and 6, and I apologize, I can't scroll down, or at least I don't think I can. No, I can't. Yeah, I didn't want to go there. As you cannot see, but you can see at the top of page 480, is in the preparation of the financial statements, you have the balance sheet, the income statement, and then the statement of cash flow. We talked about those a little earlier. 3 key financial statements. How we have here what is known as the bookkeeper's role. And the bookkeeper, notice, divides the transactions into categories that have meaning to them. And then they're posted to a record book or a computer program, and it's called a journal. Double entry bookkeeping records all transactions in 2 places, so you have a check and a balance. And by the way, double entry bookkeeping has been around for well over 500 years. It's not something new. If you don't know about double entry bookkeeping, it's not a new concept. It's been around for many, 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 many years. The ledger, for the most part, probably done on a computer today, is a book, accounting book, but there are different types of accounting things where all the information is located. And again, mostly done by computer. Trial balance is exactly what it says. And we're summarizing all this, and we're taking a trial balance, and we're going to do a little bit more to make sure that that is correct. This is computerized programs. There's one called QuickBooks. There's another one, as I remember, called Peachtree. Most of these many of these are set up for small and medium-sized companies, not to say that larger companies won't use them as well. All right, here are the financial statements. Remember the three key statements: balance sheet, income statement, and then the statement of cash flow. Here below, we see the fundamental accounting equations for the balance sheet. Assets equal liabilities plus the owner's equity. Do that again. Assets equal liabilities plus the owner's equity. Balance sheet should tell you where you stand at a specific day and time. Most companies, if they're large enough, will do this on a quarterly basis. Obviously, they're going to keep track of this throughout the quarter, but they'll have a balance sheet that shows it on a quarterly basis. They may do monthly. They probably won't do weekly, but they'll probably do monthly. A smaller company will probably keep a little closer track because it's probably a little bit more critical for them to manage the income and outgo. So they need to get that, pardon me, a little closer track on it, and they might do it a little bit more frequently. Assets can be tangible or intangible. Tangible meaning something that you can take and trade in for money. Tangible would be equipment, would be office equipment, which could be land. It could be your building. Intangible would be something like your good name, what your brand is worth if you have a brand, etc. Liquidity, and we'll go into this a little more later, is how quickly you can turn over an asset into cash. Some are turned over a little quicker than others. Classify assets in one of three categories: current, fixed, and tangible. Current is something that I can turn over within a year. When I say turnover, I mean convert it to cash, and I didn't say that, and I apologize. Fixed assets are something, notice here, the long term. We're talking about equipment, land, buildings, etc. And then intangible assets are something that are physical in a way, physical in a way, if you think of a patent, holding a piece of paper is physical. But on the other hand, in some cases, they may not have physical form, but they do have value. And it does mention patents and a few other things of that nature. And trademarks would fall into that category as well. Liability is simple. How much, what do I owe? It doesn't make any difference what it is, it's how much I owe. Accounts payable and notes payable, slightly different. Accounts payable is something that is a liability for something that I bought, merchandise or service, that I haven't paid for yet. Now, when it says here on credit, don't think of this as a way of I'm getting long-term credit like when I buy an automobile, although that may be the case. Think of this as rather as something that I have purchased and I have received an invoice and I have yet to pay the invoice. I may have 30 days to pay the invoice, or I may have a procedure that I pay the invoice at a certain time of the month. Well, it's credit because I have it, it's in my hands, but I haven't paid for it. And then notes payable, these are liabilities, would be something like a bond. I promise to pay you, the bond buyer, and we'll talk about this more when we get the bonds next week, but I'm going to pay you interest because I'm using your money, and then I have to pay you back the full face value at a certain time. Owner's equity, we talked about this before, but that is how much of the business belongs to me as the owner minus any liabilities I have. And retained earnings is this what it says. What I've accumulated from profitable operations and I, the business owner, have put into my pocket, or maybe a return to the business. Now we're going to get into some of the statements that we talked about. Income statement. It tells us what our bottom line is after we've paid everything that we have to pay. Our costs, our expenses, our taxes. And then net income or net losses is exactly, I can't change that. If we have more coming in than going out, we're ahead of the game. If we have more going out than coming in, we're behind the game. Fairly simple. Now here's the formula for the income statement. Revenue. Revenue minus the cost of goods sold equals gross profit. That's gross profit. That's not net profit, which we come to. And then we have gross profit minus operating expenses, gives us our net income before tax. Revenue is what we've taken in. And then the cost of goods sold or manufactured measures what we purchased, measures the cost of merchandise we sold, or the cost of raw materials and supplies used in producing items for resale. And then gross profit or gross margin is how much we have made less those, and we have before we get into our expenses, etc. GAAP, this is ins and outs of value and inventory. GAAP just tells us this is the generally accepted accounting principles. Now, you can do one of two things. You can do what's known as first in, first out in your accounting procedure. You can do last in, first out in your accounting. So it's different method of accounting for inventory. But what you can't do is mix and match. You have to use one or the other. You don't use both, because if you do, your books won't be accurate. Operating expenses is just whatever it costs us to open the doors for business. Notice what's on here: rent, salaries, supplies, etc. Open the doors for business. That's a little bit different than what I'd have to pay if I closed my business, because until I'm out of there, I'm still paying rent. I'm still paying utilities. Now, the utilities may be at maintenance level, but I'm still paying for them. And depreciation is, and there's a formula for this, and it gives you an idea. It doesn't mean to say you can't change the formula, but, and here's the but, once you have adopted a formula, you can't be changing the formula around. So if the government says, normally for business purposes, you have 8 years to write off the cost of machinery or equipment, you may say, I want to take 10 years. But you can't write off more than what's allowed. Statement of cash flow is simply what it says. What do I have coming in? And then we get this from our operations, from our investments, and from financing. Now, notice what it says here. Cash flow is the difference between what comes in, plus side, minus what goes out. And we have to be able to know what we have, because if we can't manage cash flow, critical for a small business, we're going to have problems. Maybe not quite so much for a large business that has other sources of income. And I'm not saying they should manage cash flow. I'm saying maybe not quite as critical. But small business really has to be able to manage cash flow. Now, there are several types of ratios to use. I don't expect you to really digest this real well, because unless you get into accounting, you're probably not going to pay a lot of attention to it. You have a liquidity ratio, leverage ratio, performance ratio. How we do these are there's some tests that you go through, the current ratio and the asset test ratio. This information is found on the firm's balance sheet. Leverage ratio, degree to which the firm relies on borrowed funds, excuse me. Debt to owners ratio, again, found on the balance sheet. Probability ratio, how well we're managing our assets and resources to be able to be profitable. And the key ratios here are basic earnings per share, return on sales, return on equity. Excuse me. Activity ratio, how effectively we're turning over inventory. And inventory is a big bugaboo because if you're not turning inventory over, it's costing you money. Costs you for storage, costs you for maintenance, maybe costs you for security people to watch it, make sure it doesn't go out. A number of other things. Again, this is found on the balance sheet. If you don't turn over inventory, there's going to be big time problems. This is just something we're talking about. We're trying to get to a universal language used in international financial reporting standards. I meant to say in reporting finances and in some kind of accounting. U.S. companies are still dragging their feet on this. Securities and Exchange Commission wants to move this forward. The last I knew, it was still gathering information and comment, and we may see something in the next year or so. One of the issues seems to be that we Americans think if we adopt an international standard, we're going to have to conform to what other people do. And that's not really necessarily true. What it says is we ought to all be able to talk common language. And if we're doing business globally, and we know that the majority, the majority of our large companies are, why not talk a common language? It just makes sense. So that's where we are. That brings us to the end of chapter 17, and we'll take a short break. It's 5:18 now, but we're on the side of caution. We'll come back at 5:21 and get into managerial finance. Please come back at 5:21. Thank you. All right, 521, Chapter 18, Financial Management. The objectives for this chapter: explain the role and responsibilities of financial managers, outline the financial planning process, and explain the 3 key budgets in the financial plan, explain why firms need operating funds, identify and describe different sources of short-term financing, and identify and describe different sources of long-term financing. Well, what's finance? Notice that finance, as used here, is a function of a business that acquires assets. Now, I'm going to use the term assets, not just funds, assets, but assets that can be turned into funds for a firm. And then a financial manager manages those funds within the firm. And this is what the financial activities are: prepares a budget, creates cash flow analyses, and then for planning and expenditures. And we kind of really talked about this already, what financial management does, a job of making sure that we keep track of and actively, and I want to use the term actively, manage the assets, funds, to help the firm be able to meet its long-term goals and objectives. This is what financial managers do. We don't need to go through all this, but I think the biggest thing to say is that they're responsible for paying bills. And bills can come from what you owe suppliers, what you owe in salaries, what you owe in taxes, and other things of that nature. But one of the biggest things, and of course it mentions a couple other things there I was going to skip over and I shouldn't, and that is making sure that you get the money that's owed to you, and then staying up with the financial market. Because especially in large firms, companies will want to invest money in some things so they get a return. And they have to make sure that they're staying abreast of that. Also, if they're going to get into the bond business, they have to make sure that they know where they are. Different terms for people here: CFO, Chief Financial Officer, a Certified Financial Planner, Financial Analyst, Comptroller, etc. We don't need to pay a lot of attention to that, but if you hear those terms bandied about, you have some idea about it, what it is. This just says 4 terms that say you need a CFO. And let's back this down a little bit. Every company is probably not large enough to have a CFO, or they don't use that term CFO. We have a CFO here at the university, but every organization won't have one. So let's not use that term Chief Financial Officer. Let's just say the person who's in charge of making sure that we got money coming in and going out and knows what's going here. And you need to have the information. If you don't have the information that talks about it, we don't know what our statement of cash flow is. We don't know what our capital is. We don't have any idea of financial forecast, etc. We need somebody in charge of that office, or somebody in charge of those functions. And we may not call that person a Chief Financial Officer, but that's what he or she's going to do. And this particular slide, which you may not be able to see real well here, but you can see in figure 18.1 at the top of page 505, gives you a pretty good idea of what these folks do. And whether that person is a chief financial officer or he or she has a different title. Just some worries for the financial manager. I think the biggest one is how much is it going to cost us to borrow money, and then the other one is staying abreast of tax regulations and things of that nature. One of the other ones that talks about as well is volatility of the dollar. Right now, the dollar is not volatile. The dollar has been rather stable for some period of time now. What is now concerning companies, especially those that do business globally, is the fact that we have a very strong dollar. And so when you have a strong dollar, it means that our merchandise is more expensive outside the United States. I'll give you an example. The last time my wife and I were in Europe a couple of years ago, 2014, we weren't all over. We were in France. We spent the time we were there in France. The dollar was around. A euro was about $1.37 to the dollar. So in other words, what it meant was if you wanted to buy a euro, you had to give $1.37. Maybe a little higher, a little lower, but that's a good figure. Right now, the dollar is somewhere between $1.12 and $1.13. Still costs you more to buy a euro, but it's significantly less than it did 2 years ago. And by the way, we were over there just about this time 2 years ago. So you can see how much the dollar has strengthened in that period of time. Why do firms fail? Well, talk about undercapitalization, that's one thing. But the biggest item here, as far as I'm concerned, is you know where the cash is. And if you don't know where the cash is, you're really going to have a lot of problems. This just gives you financial concerns for CFOs at the macro level. We talked a little bit about this before. The other big thing here is competition and, of course, credit markets and interest rates. And at the micro level, forecast results, maintaining morale and productivity, and then the cost of healthcare. Cost of healthcare is going up, and it seems to go up. We've had the quote-unquote universal health care under the Affordable Care Act, but it still seems to be going up. Good news is we have more people insured today than we had in the past. Why is that good? Well, it means that taxpayers through some other means don't have to pay for that health care for people who continually run up hospital bills or other type of medical bills. The bad thing is it seems to keep going up, and we don't seem to be able to get a handle on that. And I don't understand why. I can't talk too much about it because I don't have a good answer to pass on to you, but it's something we really have to come to grips with. Financial forecasting, financial planning. We have to think about long-term and short-term. Short-term is usually a year or less. Long-term can be 5 years, 10 years, sometimes even as much as 20, although you rarely see it go out that far. And I just told you pretty much what's on this slide. And notice that cash flow forecast tells us what's coming in a relatively short period of time, usually quarterly. Long term, something more than a year. Budgets just tell us what we think is going to come in and what we're going to have to pay out over a period of time. We really depend upon to forecast accurately a budget or to make a budget on the balance sheet, the income statement, and the statement of cash flow. And then the budget guides us. Budgets usually have some wiggle room in them. Now, what I mean by wiggle room is not room to play games, but allow for expansion and contraction. maybe not a whole lot, but for some. So it gives you some kind of an idea of whether or not you can adjust the budget to meet a crisis. I'm going to use that term that you didn't expect, or some unforeseen event. Okay, we have three budgets, normally speaking. The capital budget, the cash budget, and the operating are the master budget. Capital highlights our spending for major purchases. That would be for equipment and things of that nature, perhaps buying a new building or purchasing land or something of that nature. Cash budget is exactly what it says, telling us what we think is going to come in and what's going to go out in a particular period. Notice it not only talks about a month or a quarter. And the operating or master budget ties all the other budgets together, and it summarizes its proposed financial activities. Now, the next slide we come to, graphically displayed in your text, at the bottom of page 507, figure 18.2 shows us financial planning. Notice that it shows it to us in somewhat of a linear fashion, sort of like a rectangle here, perhaps a square. I like to think of it as more circular as opposed to other areas. Not to say that they're not distinct in places where you see them, either here on the slide that we have projected or in your text, but I think they tend to be, I like to view them as a little bit more circular, but it really doesn't make that big of a difference. It's just that you know what they're there for. That's part of the financial plan. Financial control is what we put in place to make sure we're checking our finances. And think of this as the control function that we talked as one of the functions of management many chapters ago. That's what this is. May not be the exact same way the control function was given to us then, but it's still a control function. And this is what we're looking at here. And we're going to be able to meet our financial commitments, long-term, short-term. Are getting enough, are we producing enough profit? How are we financing our assets? And we talked about this before, whether you do it by debt or by something else. And then financial needs for operational funds for the firm. Well, we have to be able to operate every day. We have to be able to control our credit in some fashion. And then we have to be able to get the inventory that we need and that's in the purchasing of raw material for the most part here I'm talking about, so we can produce whatever we want to produce. Don't have that, we're not going to be able to do what we say we want to do. This just talks about how a small business can do a better job improving its cash flow. Get after the people that owe you money. Now, don't take this as something that you're going to go out and do strong arm tactics. That would just be a little bit more aggressive. What you might want to do is say, hey, we need our money. You may not put it that way, but to induce you to pay us as quickly as possible, we'll give you a discount. And people like that. I mean, that discount may not amount to a lot of money, but it's still a discount. If your vendor gives you a special deal, extending a discount to you, you might want to purchase a little bit more, because then you've purchased it for less than what you normally would, and you can make that up and make up additional money when you're selling something. So if you normally purchase something for $100, now you're purchasing it for $95, and then you make X number of widgets, you sell them for $20 each, and you make 10 of those, or you make 20 of them. Let's get past $100. So instead of making $100, now you're going to make 105. Well, hopefully it's a little bit bigger than that, but you can do that. Raise prices. I've talked about that before. It's really something that you want to stop and think about. It's not easy to do, to raise prices, and only do that as a last resort. Debt financing, that's when you're getting money from somebody else, and that has to be repaid, and in most cases it has to be repaid two ways. It has to be repaid at the face value of what you borrowed plus interest. If it's a bond, you're going to pay the bond back however many years it is, pay the face value. But in the meantime, between the day you take the bond out and the time you pay it back, you're paying interest. Same way with a conventional loan. You're going to pay interest plus the face value. Equity financing, that's actually raising money through our own efforts. And this way, sale of ownership in the firm, we can do that through stock or something else. Short-term financing, we talked about this a little bit before, maybe in a different fashion, money that we need for current or up to a year. Long-term is usually more than a year. And this slide just gives you the difference of what we would probably use short-term financing for versus long-term financing. Slide here, and then a figure in your text at the top, figure 18.5 at the top of page 513. Short-term, exactly what it says. We have some issues. We have some things obligations we have to pay in a short period of time. We want to get rid of those and pay them off. Long-term things that we are talking about are things like new product development, upgrading our equipment, buying new equipment, things of that nature. Short-term financing, trade credit. We talked a little bit about this before, but that's buying something today and then not paying for it for a traditional amount of time, 30 days or so. That's credit. Now, it doesn't sound like credit because you know you're going to pay it, but here you're using the merchandise that you purchased and you haven't paid for it yet. And then giving people credits like this 2, 10, or net 30 days or something like that. That's the type of credit that you're getting now. That type of credit actually is the type of credit you can put in your pocket in the way of money. And what I mean by that is, again, go back to the thing that, you purchase something normally costs $100 and they give you a credit, and now you're, I use it at 5%. To say 5%, you're only paying $95 for it. So you pay in a certain period of time, and you're only paying $95 for it. Now, if you don't want to do that, you don't feel like you have the funds for it, then you just take the normal time to pay for it. Promissory note, exactly what it says. I promise you I'm going to pay you X number of dollars at a certain amount at a certain time, and I'm using the product I bought from you and I haven't paid for it yet. Kind of the same thing, except usually promissory note is extending past the normal time of paying. It's difficult to get short-term financing, and it's probably even more difficult today than it was before the Great Recession. Bankers simply don't. They tend to be cautionary people. They used to when I was growing up. Some of them are a little bit riskier today, but traditionally they don't like to loan money to a business that doesn't have the wherewithal, or they don't think they have the wherewithal to stand the test of time and be profitable. So what we're talking there is the slide makes the use of the term established business. So a small business person is usually caught in the middle here, and he or she has to look some other place to find the money that he or she may need to stay in business. This is just talking about somebody that did something, started a business. And here's the way that you can get different types of short-term loans. A secured loan is backed by some kind of collateral. That collateral usually tends to be something like property. It is saying, okay, you know, I want to take out a loan for $10,000, and what am I going to put up as collateral? I'm going to put up this piece of property that I own that's been assessed at $10,000, or maybe even more. But you know, this is what it's worth. Unsecured loans don't require collateral, and they're probably difficult to get, and they're based usually on somebody's good name or the fact that he or she has a good business or something of that nature. They're not just given because of the way you part your hair. You have to have some kind of something, not necessarily property that you're putting up, but something that says that this lender knows that you're good for it and will pay the money. You'll pay the money back. Line of credit, usually extended by banks. They'll do that for a specified amount of time, for a specified amount of money, as long as they have it. But again, you know, where you're going to get something like this is to have good credit established and have a good background. Otherwise, you probably are not going to be able to get that kind of credit. Factoring is something where a number of small businesses go to get money back at a relatively quick amount of time. Notice what this is. This is selling accounts receivable. That means I have an account, I have money that's going to come into me, and I'm going to sell that to you, and you're going to give me X dollars you're going to give me X amount on the dollar. So a factor might say, okay, I'll buy that for 90 cents on the dollar. And so what happens here is you find out that a small business will do this because they need the cash. Obviously, they're going to lose some money, but they're able to get the cash rather quickly and maybe turn that into something else. The reason that there are factors around, or people who end the factoring around, is because many small businesses simply can't get money from banks, which we talked about in the last slide or two. So they'll go to this person, they'll sell the account, realizing they're not going to get full face value, but they will get an amount of money that they think that they can live with, and then maybe turn that money into something else. Go forward. Commercial paper, usually again it's an unsecured loan. Notice that you can get it in accounts for up to $100,000, and usually that's due back to the lender within 270 days. A commercial paper is unsecured. Therefore, you're only going to see it to lend to people who have financially stable. It's not going to go to anybody else. This comes up with credit card, and I guess the only caution I would say here, especially to a budding entrepreneur, is be very careful about using credit cards. Now, if you remember back to the Pillow Pets video that we saw back in chapter 6, those folks, the people who started it, did use their credit cards. But remember, they had some background in entrepreneurial ventures, and they were willing to take a risk. So you have to be careful. If you're not willing to take a risk, just be careful. Credit card debt is high. The amount of interest charged is really very high. Remember, you use your credit card, and what you're doing is you're actually taking out a loan. And the contract that you signed says, I'll pay that back with the next number of days, whatever it is. And by the way, if you've had a credit card for a period of time, you know that the amount of time that you have to pay between the date you received the bill and the date that the bill is due has shortened. Used to be 30 days. I don't know where it's down to 21 or 22, something like that today. And then if you don't pay, there's a minimum that you have to pay. And if you only pay the minimum, then you have 18 or 20% interest rate. But that's what you're doing. You're actually taking out a loan. Or as a friend of mine says, that used to have a small business, had a small insurance agency business for a number of years with State Farm. He said he'd go to the bank and say, I want to buy some money. That's interesting way to talk about. Ways to raise up startup capital. Look for a business that's into microloans. They may not be traditional lenders like a bank or a savings and loan, but they do make things available. There's a thing called peer-to-peer lending. Obviously, talk to the Small Business Administration. They can put you in contact with these people. Look at your local banks. Some local banks will lend. A lot of local banks will do that, especially if they're small communities. And that's what they're in the business for, more so than large banks that really don't like to do that. This is some questions that you have to ask yourself when you're getting into long-term finance objectives. What are our long-term goals and objectives? What kind of funds do we need? Short-term funds, long-term funds. We need to think about bonds, and we need to think about selling stock, things of that nature. Where can we get long-term financial capital? Five C's of credit. By the way, that first one should be character of the borrower. What is his or her capacity to pay back what's been borrowed? Is the capital being invested in the business? How are we economically today? And that will tell us a lot as to whether or not you're going to be able to get a loan. I'm not going to go into this particular slide. Now we talked a little bit about short-term financing, and we've alluded a little bit to long-term financing. Notice what this says. Loans usually come due 3 to 7 years, but may go out as far as 15 or 20. Probably you may not see as many of those as much because of the financial or the economic situation that we're in the country. You know, we have seen a very peculiar recovery from the Great Recession. We have a lot of people who are either back to where they were or ahead of where they were once the crisis hit, or after the crisis hit, better way to say that. We have an awful lot of other people who are not anywhere close to that. So it's been a very uneven recovery. There are signs it looks like it's getting better, but there are a lot of people who don't believe that. And I'm not saying that they're wrong. There just seems to be a lot of angst about exactly where we are. You have to know what you're borrowing. You have to know what the term, pardon me, the term that you're borrowing for, and whether or not you have the ability to repay that within a period of time. Remember, any loan you take out, whether you're doing bonds or you're doing conventional loans, you have to pay back the principal, which is the amount that you borrowed, plus interest at specified times. Venture capitalist. I've talked about venture capitalists before, and we need to discuss this again in some respects. Venture capitalist is going to look at your company. Now, here we're talking about mostly small and medium, mid-sized companies. And what's your potential? Is your potential going to go this way, or is it going to kind of stay here, or is it not too good at all? And whether or not we're going to consider it. If we decide to lend you money, are we going to be able to get our money back? And a corollary that goes along with this, which is not here. How quickly can we get it back? Now it says they're back and more. Obviously, there's interest in whether they want to buy into the company and a few other things. But most venture capitalists that I know of, I'm not going to tell you I know any right off the bat, but most of the ones that I know of are interested in how quickly they can get their money back, plus any interest that they may be owed. And then, is it going to be worth it for us? And of course, that's, are we going to make a buck on a buck we lent? Otherwise, what's the sense? What's the purpose of doing this? This is just giving you the difference between equity and debt financing. Remember, debt financing, we're talking about taking on some kind of a loan, whether we're doing this by bonds or something else. And then equity financing is doing things like selling stock. And we can see this graphically displayed in the text, figure 18.6, the difference between debt and equity financing at the bottom of page 523. And remember, in equity financing, we're not only talking about selling stock, and we'll talk more about this next week. There's no obligation to repay equity. Never. And I buy stock, and I'll give you an example. I buy stock, and I don't have an obligation. The company doesn't have an obligation to pay me back. I hope they will. I hope they'll pay me interest, but they don't have any obligation to pay me back. Now, I happen to be, I have an elderly cousin, and I happen to have a power of attorney, and her safe deposit box had to be renewed. Well, I wanted to do that, obviously, but I also wanted to go down and check the contents of the safe deposit box. And I did, and I'll just give you an example here. My cousin had a letter in there that had been written. She'd had lawyers write, and her father, before he passed away, had bought some stock. Now, he hadn't spent a lot of money. It really was an insignificant amount of money. And she wanted to know what the stock was worth. And she got a letter back from, I don't know who this person was, saying XYZ Corporation went out of business a couple of years ago, and the stock certificate that you hold is worthless. Example of they never have to pay you back. Now, you hope that that doesn't happen, but it does. And so that's what we're saying here. Don't have to pay dividends. The flip side of that is if you borrow, we talked about before, pay back the principal, pay interest. And, it's just, you have to do it. And if you don't, people can take you to court and get the money. These are just some lessons learned from the Great Recession. We talked about financial reforms have been passed. Excuse me. Financial reforms have been passed, in business, especially financial business, are still trying to undo some of those things, but something that we need. That brings us to the end of chapter 18. We'll be back next week to do chapters 19 and 20. And the lecture question for tonight is, there are three types of budgets. What are their uses? And why do we use them? What are the uses of the three budgets? Three budgets: capital budget, cash budget, and master budget. So those are the three. What are their uses? Please post those in the forum section and for week 6. So I thank you for your attention. And unless you have any questions for me, good night.